Kia ora and welcome to the first episode of Shared Lunch for 2026, brought to you by Sharesies. I'm Helen Mattison. And today we're looking at what investors need to know for 2026. We're talking the economy, we're talking markets, and some of those burning questions like what's happening to house prices. For some expert opinion and some predictions, I'm joined by Jarrod Kerr from KiwiBank and Mark Lister from Craigs. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Mark, and welcome, Jarrod, and Happy New Year.
Kia ora, thanks for having us.
Now, it's been quite the start to 2026. We're not even a month into it. And if you look what's happening in terms of Mr. Trump, Iran, Venezuela, Greenland, and even the independence of the Federal Reserve, which is the central bank in the US, who would know that we'd have such things happening all at once? So I think, Mark, let's start with the US markets. Sharesies investors love the US, but it was quite interesting to me that actually last year, although they were going gangbusters, they weren't the markets that did the best. It was Japan and Europe. So go figure.
Yeah, that's right. Last year, really interesting. And if you take those big five share market regions across the world, you've got the US, you've got Europe, you've got the UK, Japan, and emerging markets, which includes China. The US was actually last out of all of those five, last place. And then you think about the Mag 7, all of those tech stocks that we know and love. 5 out of the Magnificent 7 underperformed the S&P 500. So there's a lot of narratives out there in the market. The US has been the strongest market. It's been all the tech stocks, all the Mag 7 that aren't entirely true. So really interesting, isn't it? The US still did exceptionally well. It was up 16, 17% last year, so a cracking return. But there was more money to be made in some of those other markets.
So does that mean we might want to pivot or have more diversification? Because the concentration, for example, in the S&P 500, I think 10 of the biggest stocks are mainly tech, mainly aligned to AI, and they are 36% of the bourse. So is it time to sort of reconfigure and think not like we used to?
Oh, look, yes and no. I think those top 10 stocks, and it's all the household names, I think they're north of 40% of the S&P 500. Concentration isn't something new. The last 30 years, I think the top 10 have been on average 20 to 30%, which is chunky numbers, but 40% is a notch higher again. So look, is that concerning? Yeah, I think it is to a degree, but it's not completely new. Share markets are interesting. You look back through the history of share markets, and most of the returns tend to be driven by a very small group of stocks. There's a whole lot of stocks that do either badly or average, and there's a small group that do very well, and that's where you get your returns. So I think you do have to I don't think we want to give up on those AI stocks, those tech stocks. We just want to have an awareness that they're very big, they're very dominant. Look, if that bothers you, if that makes you nervous, then there is a world outside of those sectors and stocks and outside of the US. The US is about 65% of global share market indices, so it's the big kahuna. It's the world's biggest economy, the biggest share market, biggest bond market, and that is where the world's best companies live. So you don't want to give up on it. But I think the message is more, don't forget that there are regions outside the US. There are a lot of interesting opportunities in Japan, in Europe, and other parts of the world. So it's not a case of one or the other. I would say just be well spread and maybe hedge your bets if you're starting to get a little nervous about that level of concentration.
Mark, we won't labour too much on this because I think everyone's sick of it, but the AI bubble that was talked about ad infinitum last year, do you have any views on where that could go this year?
Look, I personally don't think it's a bubble. A lot of people compare it to what we saw in the late 90s, around the turn of the century. And there are similarities, but there's also a lot of key differences. The companies you've got now, at least the big ones, because there are unprofitable tech companies that are very highly valued. But when you look at whether it's the Microsofts or the Nvidias or the Apples or the Amazons, these are fantastic businesses that are very dominant, very profitable, with very strong margins, and they have become essential parts of our life. They're almost sort of infrastructure in a way. And the valuations are expensive, but they're not nearly anywhere near where things got to in that period 25 years ago. So for me, could it be a little bit overheated? Yeah, possibly, but I don't think we're in bubble territory. And while there's still such strong earnings growth coming through, I still think there's a case for the US market performing well. But again, if people are worried about that, then just be well diversified.
Jarrod, if we think about the geopolitics and where New Zealand stands, it would appear at the moment, particularly with Europe and what's happening with Greenland, that Mr. Trump not has a big stick, but has a big economy, and he has lots of power, and everybody's sort of, tiptoeing around him. Is there anything that for New Zealand that we need to be aware of, or does the reverberations come this far down under?
Oh, they do. If something big enough and outrageous enough does actually affect global markets, then it ripples its way through to New Zealand quite quickly. But we're not there at this point. A lot of threats. The tariffs of last year, I think, was a classic example of something that really threatened us. And most economists globally wrote off a whole lot of expected growth, only to then put it back in once the tariffs didn't turn out to be quite as bad as originally feared, and even having tariffs removed from us on the likes of beef and kiwi fruit and a few other things, right? So the exporters that I spoke to over that period, none of them were that concerned, because they were diversifying more into Asia and Europe, and those that had good export market into the United States were saying that was their most profitable market. So there was room to wiggle room on that tariff anyway. So that was the big one. And now everything else that you mentioned is just more and more Trump being Trump. And I think it's the way I would say it to clients, it's a watch. It's a must watch, but it's not a react. It's watch and don't react. And if financial markets are strolling through this, then I'm not immediately concerned at all. And what I'm actually excited about is that, we've now got what I think are the right conditions for a proper recovery this year, not the one that we had last year, which kind of stalled and we sort of choked and spluttered and struggled to get up off the ground. I think we're on our knees and we're about to start jogging.
I think markets are able to write some of that stuff off as noise, because the US and other parts of the world are still ticking over nicely in an economic sense, when the fundamentals still look okay. It might be a different story, whether it's the tariffs, whether it's some of the other worrying things that we're seeing. If you were getting a real drop-off in activity or sort of any recessionary alarm bells, then it might be different, mightn't it?
Yeah, absolutely. But we just didn't get that, thank God. Like I said, the IMF, the World Bank, all these very serious forecasters said, right, the tariffs are coming through, we're slashing our global trade volume forecasts, and as a tiny open economy like New Zealand, to see all that happening, really did scare us there for a minute. But only a minute, and we've fought our way through it, and now those forecasts have been revised actually higher than what they were.
One thing that does scramble markets a little bit, though, is inflation and rate cuts. And, obviously every time the Federal Reserve drops or hikes, we feel it down here kind of thing. They've sneezed and we feel it. What about back here in New Zealand, though, in terms of rates? I mean, we are in a low-ish interest rate environment. That rebound, or I think recovery is probably a more apt word. What is in our toolbox to make that happen?
Well, there's a lot in the toolbox, but the main tool is a very blunt one, and that's the interest rate that you were talking about. The Reserve Bank has used it with a very heavy hand in recent years. They slashed it to near zero during COVID. They hiked it, into the mid fives. Both moves very aggressive. Both moves had big impacts on the economy. We fell into a recession, and we've been in a very awkward period for the last few years. We haven't really recovered, and that's because the cash rate hasn't been where it needs to be. They have only just cut the cash rate below a neutral rate. So we had it at a restrictive level. You've got your foot on the brake. They cut it down to 3. That's neutral, right? You've basically just put the car in neutral. You're not going anywhere. Only recently have they gone down to 2.25. So only recently we've just seen a slight tap on the accelerator. So yes, confidence is lifted as these rates have fallen to levels that are stimulatory. And what we need to see is that confidence turning into actual activity. And we've seen signs of that in our spending data. We've seen it in the NZIER business. It's coming through. And we're a lot more confident with a cash rate that's in stimulatory territory than a cash rate that's at neutral or above.
Yeah, because some of the only green shoots last year were the rural economy was doing quite well, but that's tapered off somewhat. But are you saying that this is a lot broader, this recovery?
We're hoping it becomes a lot broader. So the one thing I liked the best about that NZIER one was the lift in manufacturing. That manufacturing sector is key for us, and it's sensitive to the Aussie-Kiwi currency cross, which has gone in our favour again. So yes, we had a farming and growers market there for a while. You saw that in different regions, particularly the South Island, larger farms, less debt than in the North Island. So that terms of trade boost, largest we've ever seen in this country. $10 payout for dairy powder, not bad.
Yeah.
That was great. Now I think we're seeing more of that money being put in, because what we noticed is that a couple of the large banks actually pulled back on their lending into agriculture. So the farmers are actually forced to pay down debt, and a lot of them wanted to pay down debt. So you might be getting a high payout, but that's not necessarily feeding into the economy if you're running down debt. I think we're at a point where they've done that, and we're starting to see more feeding through. And with these rate cuts to levels that they are now, if we see that pick up in retailing or consumer, then that's a lot more broad-based.
I think you're going to get a really good read on that and more through this upcoming reporting season in New Zealand, because a lot of indicators that we see, not the QSBO, that's a bit more up to date, but a lot of economic indicators tend to be backward looking, don't they? But right on our doorstep is the February reporting season, second half of Feb, whether it's the freightways or the port companies or whoever. All of these management teams and CEOs are going to tell you how are things for us today and what do things look like, in the immediate future. And with a bit of luck, I'm with Jarrod. I think there is a broader recovery story coming through, and hopefully some of those outlook commentaries will give us a bit more evidence of that.
Yeah, because the last two earnings seasons, we have had some companies had some pretty dire results, haven't they? And it was looking quite bleak, the forecast.
Well, I think more than two. It's probably been the last six monthly reporting seasons. Yeah, and if the CEOs of these big companies that have a lot of economic touch points, if they can't sort of see light at the end of the tunnel, if it still looks cloudy, it's pretty tough to get confidence. But I think we might be almost there this time around, and I'm hopeful that they'll be talking about the results from the second half of last year. But when they talk about this is how the last 4 to 6 weeks, the early part of 2026, I'm hopeful that we'll have seen an uplift in activity.
So with that regard, then, what sectors do you think have some promise? Say, if we're looking at the NZX and the ASX.
Well, I still think those interest rate sensitive companies will do well. Like Jarrod said, we had that high OCR, 5.5% for a long time. Now we're down at 2.25%, so it's not as low as it was pre-COVID, but it's still much lower than we've seen in a long time. And TD rates have been close to cut in half. So I think there's definitely going to be increasing interest from investors, and whether it's the utilities companies or some of the infrastructure companies, listed property, which was in the dog box for years,
Yes,
and then had
yeah.
a cracking year last year. Commercial property looking a lot better.
That's right,
So
yeah.
some of those sectors are probably looking a little bit more enticing to investors. So I still think that theme has got legs as you sort of move through the year, and as people have more confidence about things like manufacturing, other parts of the economy. Maybe you will see some of those more cyclical, economically sensitive parts of the market perform a little bit better.
And ASX, I mean, it's traditionally for Kiwi anyway, been banks and miners. Is there emerging markets or emerging technologies, and more mid-cap type opportunities rather than those great big, BHP or whatever it might be?
Look, if I'm honest, I struggle a little bit with Australia. The US and Europe, that's where all of the action is at. Those are the biggest, best parts of the world to invest. New Zealand is teeny tiny, so the textbook would sort of say, you don't need to invest in New Zealand, but because you get the imputation credits here as a New Zealand investor, there's quite a significant tax advantage that we get. So that sort of counters that argument. So there's a valid tax reason to invest locally because we get that, much better tax treatment. Aussie's kind of a no man's land because we can't use the franking credits. And are the companies there really better than what you'll find in the United States? Oh, I'm not sure.
Interesting.
Resources, though, that's probably where I do see value in, personally thinking about inflation, thinking about all of that. I'm in the camp where having some commodity exposure, some real assets, tangible natural resources is quite sensible to have as part of, if anything, your alternative assets, but using the Aussie miners is a good way to do it because commodities do tend to perform well when you've got that high inflation backdrop. And just in case we're all wrong about inflation being under control, just in case there is another shock, another scare, I think there's a valid case for that sector. So that interests me about Aussie. Small caps, lots of great small caps, mid caps in Australia, but it has been a minefield for people choosing them. So
that's right.
I think wise to maybe use a credible fund manager who's investing in small caps, mid caps over there, and who has a track record because it's tough to do on your own.
The one that has been interesting too is precious metals. I mean, gold has had an outstanding year. I think it's 60% last year.
Yeah.
We haven't seen that since 1979 or something
that's
crazy
right.
like that. I know you've talked about it a bit, Mark, and I think silver is another one. Are you invested?
Silver was up 150% last year, and I got a telling off from a client today because they saw something I wrote on LinkedIn where I talked about, everything, what it had done last year. And I said, gold's done 65%. And, well, you missed silver. It's done 150%. Yep. Precious metals been fantastic. Both of those highest years since 1979. Look, you can sort of see why. We talked about some of the geopolitical risks and issues.
Yep.
The US dollar's been weak. That's a positive for precious metals. Everyone's worried about US debt, where it goes, spending. Everyone's worried about sort of, it's a laundry list of things to worry about. So, I think there's a case for having a small allocation to precious metals, gold or whatever. I think you put it in your alternative assets, sort of part of your portfolio. Don't go overboard. Gold can be super volatile. So, it's had a great run lately.
Interesting. Yeah.
It won't necessarily continue, not at that same pace, but there is a case for having those. I've got a little bit of gold, and I keep it to sort of 2 or 3% of my portfolio, and I think of it as an insurance policy rather than investment. So I've sort of got it there. I hope it doesn't go well, because when it goes well, it usually means there's trouble somewhere else. That's the way I sort of think about it. It's not a must own, but it can sort of help you during these periods.